You blinked, and the market tanked. The Dow Jones, NASDAQ, and Russell 2000 all plunged in free fall. An avalanche no one saw coming in minutes, with no bounce back. Investors in shock, experts speechless. What's behind all this? And more importantly, what should you do with your stocks now? Like, comment, and share this video. Understanding what's happening could save your financial future. The sudden stock market drop. This past week, global markets saw one of the fastest and most synchronized sell-offs of the past decade. The Dow, NASDAQ, and Russell 2000 sank together, with no signs of support or intraday recovery. It was as if someone pulled the plug, and everything went dark. It felt like a wave of coordinated panic. Buyers vanished, leaving only desperate sellers behind. This kind of move isn't normal. Usually, we see sector-based swings or technical pullbacks. But this time was different. Liquidity vanished. Even fundamentally strong stocks got caught in the selling pressure. That shows this wasn't a rational adjustment. It was a chain reaction driven by emotion. What does that mean? A synchronized collapse like this often points to something bigger behind the scenes, and the market sensed danger. When major players exit all at once, it's a red flag for everyone. It's like a fire in a crowded theater. Everyone rushes to the exit at the same time. Bond market turmoil. On the same day, a U.S. Treasury auction for 20-year bonds brought another shock. Demand was dramatically low. The yield spiked to 5.047%, far above the average of the last 6 auctions at 4.61%. This shows investors are demanding more to lend money to the government. The fear isn't just about high rates. It's about losing fiscal control. This sharp jump in yields affected bonds across all maturities, from 1 to 30 years. And it's not just a statistic. It's the market screaming for help. It's as if trust in the government's fiscal management took a hit. Risk is now being aggressively priced in, as if the system is under strain. When the government has to pay more interest to borrow, it affects everything, from mortgages to business loans. That means more expensive credit, less consumer spending, and slower growth. It's a domino effect, and the problem is that the consequences often hit weeks or months later. Sector-specific impacts. Some sectors were hit harder than others. Housing and construction-related companies took a big hit. FICO dropped 15%. Rocket Mortgage fell 7%. The reason's clear. High interest rates discourage finance purchases, bringing the sector to a halt. Plus, institutional investors are pulling away from credit-based and domestic equities. In retail and home appliances, Whirlpool lost 6% and RH, formerly Restoration Hardware, fell below $200, a critical level for institutional investors. This shows the end consumer is hesitant and feeling the macro pressure. Households are focusing on essentials and cutting what's considered non-essential. Consumer spending is tightening, and that trickles down to production. When sales drop, companies cut inventory, delay investments, or lay off workers. It's a vicious cycle that can intensify quickly if rates stay high. Credit-sensitive sectors are the first to fall in this kind of environment. The bond-equity relationship. When bond yields rise, money flows out of stocks. It's simple. Why take on stock market risk if you can earn 5% or more in near risk-free government bonds? It's a direct cause-effect relationship. Higher bond appeal equals less stock inflow. And in this scenario, even strong companies can suffer unfairly. The biggest concern: if long-term yields reach 7% to 8%, we could see a massive capital migration towards safe assets, triggering another wave of equity sell-offs. That pressure can spark panic. It creates a self-feeding cycle. Selling leads to more selling. This inverse relationship between bonds and stocks is a cornerstone of financial markets. Ignoring it is like sailing through a storm without a compass. Knowing how to read this shift is key to protecting and adjusting your portfolio. This is when macro analysis becomes essential for serious investors. Historical comparisons. If you lived through 1965 to 1982, you'll remember stock markets were basically flat for nearly 2 decades. Why? Because Treasury bonds were paying 7% to 16% annual yields, with almost no risk. Safer, higher returns made equities unattractive. Then from 1982 until now, with interest rates falling steadily, we saw the opposite. one of the biggest bull runs in history, with the S&P 500 gaining over 4,700%. Low rates fueled a boom in risk assets for nearly 40 years. It was a golden age of inflated multiples and credit-driven growth. The takeaway: the cost of money shapes the market. High rates kill risk appetite. Low rates fuel it. Right now, we're leaving the era of cheap money and entering unfamiliar territory, where decisions are tougher and impacts more unpredictable. Investors need to rethink where and how to allocate capital. Today's uncertainties: the perfect storm isn't over. A new U.S. fiscal bill is under debate with potential inflationary effects. Trade tariffs on strategic goods are also on the table, which could push prices up even more and complicate policy choices. The legislative environment is now a direct market risk. At the center of it all, the Federal Reserve. Should it cut rates to support growth or raise them to fight inflation? The uncertainty lingers, and this keeps investors frozen. A Fed timing misstep could amplify the damage. Lack of clear signals is adding to market anxiety and volatility. The classic advice: when in doubt, stay out. But staying out also has a cost. Missing out on a quick recovery or failing to protect your portfolio can be just as damaging long-term. Right now, strategy needs weekly adjustments, not quarterly ones. Market outlook: despite all the fear, investor sentiment remains broadly bearish. And ironically, that could be a good thing. In markets, consensus rarely pays off. When everyone's scared, big opportunities emerge. The biggest rallies often start in the depths of despair. Historically, markets rise when most expect them to fall. That's the contrarian effect. The bottom rarely feels safe. It feels like the end of the world. But we've seen this before. In 2008, in 2020, and even back in 1987. History is full of epic reversals after periods of panic. Also, upcoming events, like NVIDIA's earnings report on May 28th, could change market sentiment overnight. AI remains the market's biggest driver. A strong report could reignite risk appetite. And since markets run on narratives, that spark might be all it takes. Hedging portfolio decisions. Many investors considered hedging with put options, but many chose not to, and for good reason. The cost of protection surged, and in a moment of extreme fear, hedging can mean overpaying for safety that might not even be needed. Timing is everything when it comes to hedging. First, a lot of investors are already bearish, meaning a lot of hedging is already priced in. Second, many funds are holding substantial cash, which itself is a buffer against losses. Having liquidity today is a strategic edge. In tight markets, cash is power. Also, finding good short opportunities is getting harder. Markets are more technical than ever, and any mistake can be costly. Instead, staying disciplined, holding strong positions, and focusing on fundamentals is what really makes the difference. Reacting in a panic can be more dangerous than the event itself. Key corporate news. Meanwhile, one piece of corporate news caused a stir. Johnny Ive, former chief designer at Apple, just joined OpenAI. That raises questions about Apple's creative future and might signal changing tides even for the giants. When top talent leaves industry leaders, the market pays attention. United Health, one of the biggest healthcare companies in the U.S., plunged over 6% in a single day due to regulatory investigation concerns. The healthcare sector, usually seen as defensive, is starting to show cracks. What was once a safe haven is now being reassessed. Nothing seems immune when confidence falters. The message here: staying cautious is essential, but avoiding panic is even more important. Markets punish both excessive risk and paralyzing fear. The key is balance and preparation, and that only comes with information and strategic clarity. So what can you do now? Watch upcoming Treasury auctions. They're the risk thermometer. Track inflation reports closely. Follow every Fed move like you're monitoring tectonic plates before an earthquake. The market is sending a loud and clear message. We're in a new era. Rising yields, falling stocks, fiscal uncertainty, and Fed decisions in the spotlight. But with the right information, strategy, and a calm mindset, you can turn this chaos into opportunity. Remember, moments like this separate amateurs from legendary investors. Like, comment, and share this video to help more people protect their investments and truly understand what's at stake. And remember, your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth-building strategies.